What if your business could print money on autopilot? Mike Michalowicz's Profit First isn't just a book. It feels more like a financial rebellion, really.
Yeah,
Let's
absolutely.
crack the system that's reportedly saved, what, 175,000 businesses from bankruptcy?
That's a huge number.
Welcome to this deep dive, where we sift through the noise to bring you the core insights. Today, we're plunging into the Profit First system.
Looking forward to it. We've got some interesting sources lined up.
We do. Our sources include a personal review after 6 months of, putting it to the test, a business book summary,
Uh-huh.
another thoughtful review, and some excerpts detailing the core philosophy behind it all.
Right. Good mix.
So our mission today is pretty straightforward. Let's extract the crucial principles and the practical steps of Profit First and really see how this could genuinely shift the financial landscape for you, the listener.
Exactly. And having these different angles from the sort of theory to the actual on-the-ground experience should give everyone a really clear picture of what Profit First is and, importantly, how it can actually be put into practice.
Okay, so the whole Profit First approach hinges on a pretty radical change, doesn't it, compared to how we've traditionally looked at business finances.
Definitely.
We've all been taught that standard accounting equation, sales minus expenses equals profit. But what's the real world snag with that? Why isn't it always working for entrepreneurs?
Well, the fundamental problem is that profit often ends up being the forgotten element, doesn't it? It's like an afterthought.
Right.
Businesses naturally focus on getting sales in the door and then making sure they cover all their costs, rent, salaries, supplies, and profit becomes whatever happens to be left over. And often that's not much at all.
Yeah, been there.
It leads to this situation where you're working incredibly hard, maybe revenue looks good, but the actual profit you're seeing is minimal, maybe inconsistent.
Right. And that's where Mike Michalowicz throws this curveball with his Profit First formula. Sales minus profit equals expenses.
Exactly. Flips it on its head.
It sounds deceptively simple, but it represents a total shift in mindset, right?
Yeah.
What's the core idea behind prioritizing profit like that right there in the equation?
The central idea, as the name suggests, is making profit the priority from the very beginning. You decide on a specific percentage of every sale, every bit of revenue, to allocate to profit first.
Before anything else.
Before anything else.
Right.
And that fundamentally alters how you view and manage your expenses. It essentially forces you to run your business on what's left over after profit is taken.
Which encourages efficiency.
Totally. Greater efficiency, much more intentional spending. As Michalowicz says, and we see this echoed everywhere, profit is not an event. Profit is a habit.
I like that.
The key insight here is by making profit non-negotiable, part of every single transaction, you start building a consistently profitable business. It becomes routine.
Profit is not an event. Profit is a habit. That's a really powerful way to think about it. Now, one of our sources brought in this interesting small plates analogy. Can you explain that? How does it help us grasp this?
Yeah, it's a great analogy because it taps into basic human behavior, doesn't it? Think about a buffet. If you grab a smaller plate, you naturally tend to take less food.
Yeah, subconsciously maybe.
Exactly. The same principle applies to your business finances with Profit First. By using multiple dedicated bank accounts for different purposes, profit, owner's pay, tax, expenses, you're essentially creating smaller plates for your money.
Oh, yeah.
This visual segmentation, the separation, encourages much more disciplined spending within each category. The funds are clearly earmarked, and they're not just sitting there in one big tempting pile.
So you can't easily dip into the tax money for, say, a new piece of equipment.
Precisely. It leverages a psychological bias, Parkinson's law really, that demand expands to meet supply to naturally control spending. Less money available feels like less money to spend.
So instead of one big pool, you've got these distinct labeled containers. And Profit First gives a specific blueprint for these, right? These 5 core accounts.
It does. The allocation system is the real engine here, and it revolves around 5 fundamental bank accounts.
Okay, walk us through them. Let's start with the income account. What's its role?
The income account is basically Grand Central Station for your revenue. All the money your business generates from every source lands here first.
Okay, everything goes in.
Everything goes in. But importantly, according to the method, it's mainly a holding place. Its purpose is to receive the money and then act as the single source from which you distribute funds to the other specialized accounts, not for spending directly.
Makes sense. The clearinghouse. So all cash lands there first. Then the very first transfer out goes to the profit account. Tell us about that one.
This is where the core magic, if you will, of profit first happens. The profit account is where a predetermined percentage of that income gets transferred first.
Before rent, before anything.
Before anything. That's the foundational step. It ensures profit isn't just a leftover number, but a planned, intentionally prioritized part of your financial strategy ongoing.
And there's a psychological win there too, right? Seeing that profit build up.
Huge psychological boost. Seeing that account grow validates your hard work. It incentivizes you to keep finding more profitable ways to do things. Interestingly, one reviewer, Elizabeth McCravey, mentioned using this as a sort of emergency fund,
Oh, interesting.
which isn't strictly the initial book recommendation, but it shows how people adapt it, It highlights that flexibility.
That's a great point. Adaptability is key. Okay, so after that first slice goes to profit, where does the money flow next?
The next crucial account is owner's pay. This is specifically designed to make sure you, the owner, the one putting in the sweat equity, get consistent, fair compensation.
Which so many founders neglect.
They really do. It promotes your own personal financial stability and helps break that awful habit of just pulling random amounts from the business account whenever you need cash. That just muddies the waters.
Yeah, it makes it impossible to see real profitability.
Exactly. Michalowicz emphasizes the owner is the hardest working employee and deserves to be compensated fairly. A dedicated account makes that real. You prioritize your own financial well-being.
Absolutely. It recognizes your value. What about the tax account? That sounds like a fantastic way to avoid those April surprises.
Oh, it can be a major stress reliever. The tax account is where you regularly set aside a portion of your income specifically for taxes, sales tax, income tax, whatever applies.
Like a forced savings plan for the tax man.
Pretty much. By allocating funds consistently throughout the year, you avoid that frantic scramble when the deadlines hit. It gives huge peace of mind and stops taxes from disrupting your cash flow.
Smart. Very smart. So income flows in, a piece goes to profit first, then owners pay, then funds for taxes are set aside. What happens to whatever's left after all that?
That brings us to the final core account, the operating expenses account, or OPEX. This is where the remaining funds land after all those other priority allocations are made. And the critical part here is your business must learn to operate, to function, to thrive using only the money in this account.
The constraint principle again.
Exactly. That natural constraint fosters cost consciousness. It encourages smarter, more efficient spending because you have a clear, defined limit on what's available for the day-to-day running of the business.
Okay, we've got a good handle on the 5 core accounts now. But for someone listening who's thinking, okay, I'm intrigued, how do they actually start? What are the first practical steps?
Right. Implementation. Several key steps. First, you need to assess your current financial situation. Really get honest.
Okay, where do you begin with that?
It starts with calculating your real revenue. Now, what's that? It's your total revenue minus your direct cost of goods sold or materials and subcontractors. This gives you a clearer picture of the actual money available for allocating.
So not just top-line sales, but what's left after direct costs.
Precisely. Then you need to figure out your current allocation percentages, your CCAPs. Essentially, how is your money currently being divided? What percentage is going to expenses? What are you actually taking home? What are you setting aside for tax, if anything?
So step 1, know thyself financially. Understand the current reality. What's next?
Once you know your CCAPs, your starting point, the next step is to set your target allocation percentages, or TAPs. These are the ideal percentages you want to be allocating in a healthy business.
And how do you figure those out?
Mike Michalowicz provides some suggested starting points, especially for businesses under, say, $250,000 in annual revenue, maybe something like 30% for expenses, 50% owner's comp, 15% tax, and 5% profit.
Okay, those are helpful benchmarks.
They are. But as Elizabeth McCravey pointed out from her own experience, these are just starting guidelines. You really need to adjust them based on your specific business, your industry, your goals. They're not set in stone.
Right, so those initial numbers are more like a compass heading, not a rigid map. Got it. Once you have your targets, you don't just flick a switch. That sounds disruptive.
Absolutely not. That would be a huge shock.
Okay.
The third essential step is to gradually adjust your percentages. You move incrementally from your current CIPs towards your target TIPs.
Slowly, gently.
Very gently. One source even suggests starting with a tiny profit allocation, maybe just 1% of revenue.
Just 1%.
Yeah, just to begin building the habit of taking profit first. That's more important initially than the actual amount.
That makes perfect sense. Slow and steady wins the race. What other practical things are key to making this work?
Well, maintaining unwavering discipline is just paramount.
Yeah.
You have to stick to your allocation.
Resisting temptation.
Totally.
Yeah.
Resisting that urge to dip into the profit or tax accounts to cover operational costs, even when things feel tight. As Michalowicz says, discipline is the bridge between goals and accomplishment. That discipline turns the theory into real money in the bank.
Easier said than done sometimes, I bet.
Yeah.
Now, a really tangible part, as McCravey emphasized, is actually setting up those multiple bank accounts. Why is that physical step so important?
Setting up the separate accounts isn't just like a logistical detail. Michalowicz considers it fundamental, non-negotiable.
Really? Non-negotiable.
Yeah. As McCravey described, sure, it might mean a trip to the bank, some paperwork initially, maybe a bit of hassle, but the long-term benefits are huge. These distinct accounts give you that clear visual separation of funds. It makes it incredibly easy to see exactly how much you have for profit, for tax, for paying yourself.
That visual clarity.
It's a powerful tool for managing spending and reinforcing that profit-first mindset. McGrady set up 5 accounts: income, expenses, owner's comp, taxes, and profit, which she also, earmarked as an emergency fund backup.
And are there banks that make this easier now? She mentioned Relay.
Yeah, she mentioned Relay as a platform that's becoming known as profit-first friendly. So technology might be simplifying the setup process now compared to when the book first came out.
Okay. And for someone feeling overwhelmed by opening like 5 new accounts immediately, did McCravey offer any baby steps?
She did acknowledge that. While the book strongly pushes for separate accounts right away for that visibility, she suggested if that feels like too big a leap initially, you could potentially use budgeting apps like YM. You need a budget to kind of simulate the separate pots of money within a single account.
Like virtual envelopes.
Exactly. But she was quick to stress that ultimately, the physical separation in actual distinct bank accounts is much clearer, more effective, and psychologically more powerful for really embedding the profit-first habits. That clarity is hard to replicate digitally.
Okay, so ideally separate accounts, but maybe start with an app if needed. Got it.
Right.
Once the accounts are set up, what's the regular rhythm? How does the money flow month to month or maybe more often?
The flow becomes quite structured. McCravey outlined it well. All your income, wherever it comes from, PayPal, Stripe, checks, gets deposited into that central income account.
Okay, step 1, money in.
Right. And ideally, that account is just for receiving. Then, on a regular schedule, maybe the 10th and 25th of the month, something consistent, you do your allocations.
The distribution.
Exactly. You systematically transfer funds from the income account out to the other 4 accounts: profit, owner's pay, tax, OPEX, based on your target percentages.
And the income account ideally goes back to 0.
Pretty much. Or close to it. The goal is that all the revenue that came in during that period gets intentionally distributed according to your plan. It's a very active management process.
So it's this regular disciplined dance of moving money and getting a super clear picture. Now, we've covered the mechanics, but it feels like Profit First taps into some pretty significant behavioral stuff too, doesn't it?
Oh, absolutely. As McCravey observed, it's way more than just bookkeeping. It's financial management rooted in behavioral psychology.
How so?
The physical act of moving money between accounts creates this strong visual accountability. Seeing the profit account balance grow, that's powerful motivation. It reinforces the value of what you're doing.
And seeing the OPEX account limited.
Exactly. Seeing the finite funds in the operating expenses account naturally curbs overspending. It makes you think twice. One source even shared a case study. A bakery increased profitability by 30% in just 6 months. That shows the real impact of these behavioral shifts.
Wow, 30% in 6 months is impressive. Now, for someone listening who's maybe just starting out, barely covering costs, they might think, this sounds great, but I need more clients first. What's the answer to that?
That's a really common and understandable concern. McCravey actually addressed it. While she personally waited for consistent clients before doing the full separate bank account setup, the fundamental principle of prioritizing profit, even a tiny percentage, can and should start from day one, even 1%.
Even if it feels like you can't afford it.
Especially then, perhaps, because the system, as one text pointed out, is designed for solopreneurs and SMEs often living check to check. Starting small builds the habit, that profit muscle. That's the cornerstone Michalowicz keeps emphasizing. Build the muscle, even with a lightweight.
That's really encouraging. Start small, build the habit. Another interesting point was the emphasis on avoiding debt. How does Profit First connect with that?
It's a core tenet. The profit-first approach strongly advocates using your generated profits to fund growth and expansion rather than relying on loans and racking up debt.
Profit-powered scaling, I think one source called it.
Exactly. Michalowicz, having had his own tough experiences with debt-fueled businesses, pushes for this. By consistently taking profit, you're building a stronger, more sustainable financial foundation. You can fund your ambitions without the risks and burdens of debt. It's about organic growth from your own success.
Makes a lot of sense.
Yeah.
Grow sustainably. And Profit First isn't a set it and forget it system, is it? Regular reviews are important.
Absolutely correct. It's dynamic. The system specifically recommends quarterly assessments. You need to look at your allocation percentages regularly.
Why quarterly?
Because your business changes. Revenue evolves, expense patterns shift, maybe your goals change. You need to revisit those target allocation percentages, TAPs, to make sure they still reflect reality and are still pushing you towards your profitability goals. That ongoing review keeps the system effective and aligned.
Right. Keep it relevant. Now, technology. It touches everything. How does it intersect with Profit First? Are there tools to help?
Technology can definitely help streamline things. As we mentioned, platforms like Relay are now Profit First certified, potentially automating those transfers based on your percentages.
That could save time.
For sure. And predictive analytics tools might emerge to help forecast taxes or even suggest optimal profit percentages based on your data. Accounting software like Xero can integrate to give real-time spending insights.
But there was a caution too, wasn't there? About too much automation.
Yes, an important caution. Over-relying on automation might dilute some of the key behavioral benefits. That conscious, manual process of moving the money, seeing the allocations happen, there's a mindful aspect there that really reinforces the discipline. Don't automate away the awareness, essentially.
That's a really insightful point. Don't lose the intentionality. Okay, we've heard a lot of positives, but one source, Straight Up Bookkeeping, offered a slightly different take. What were their counterpoints?
Right. Straight Up Bookkeeping agreed with the core idea, prioritize profit, but they had a couple of reservations.
Okay.
Firstly, they questioned the idea that traditional financial reports are inherently too complex for entrepreneurs. They argued that with good bookkeeping and modern software, owners can understand their financials without needing this specific system.
Fair enough. What else?
Secondly, they felt the book's suggestion of maybe needing up to 12 different bank accounts could be excessive and might actually create complexity. They suggested good bookkeeping within a simpler account structure could work just as well.
So they like the goal, maybe not all the specific mechanics for everyone.
Pretty much. The disagreement wasn't on Profit First as a principle, but more on the perceived complexity of traditional reports and the necessity of numerous bank accounts.
That's a fair perspective to include. Different strokes for different folks, maybe? And McCravey also mentioned adapting the system herself, right?
Exactly. Her experience shows that people take the core principles, prioritize profit, use separate accounts for clarity, but then they tweak it. They adjust the percentages, maybe the number or names of the accounts to fit their specific business reality and preferences. It's a framework, not rigid dogma.
Okay, so wrapping this up for our listener, what are the absolute crucial takeaways, the actionable things to chew on after this deep dive?
Okay, key takeaways. First, start incredibly small. Even 1% profit allocation builds the habit. It's about the routine, not the amount initially.
Got it. Start small.
Segment ruthlessly. Use those separate bank accounts. McCravey and Michalowicz are clear that visual clarity brings control. Don't just keep it all jumbled together.
Separate accounts.
Third, pay yourself first. Make owners' compensation consistent and planned. It's vital for your motivation and sustainability. Don't be the last one paid.
Prioritize your own pay.
Yes. Fourth, focus on cash flow. Profit First gives you this powerful lens on cash management, which can be more immediately useful day to day than just looking at P&L statements.
Cash flow focus. Okay.
And finally, remember McCravey's conclusion. Yeah, it takes some setup, some adjustment time, but the result can be this profound new money confidence and clarity. That transformation is the real payoff.
That's some really valuable practical advice. So in a world of side hustles and, let's face it, burnout, Profit First isn't just about the money. It's really about freedom, isn't it?
It really seems that way for many people.
Remember, profit isn't what's left. It's what you fight for first. If this deep dive into Profit First sparks some ideas for you and you want more business-boosting insights, be sure to like and subscribe for more deep dives just like this one.
Definitely do.
Thank you for taking this deep dive with us on the Inspired Podcast.